What we've seen in probably the last month or so after the U.S. election is a stronger dollar, higher than expected rates in the U.S., and that slowed down the run-up in gold prices. Why? Because remember, the main buyers of gold in the last couple of years have been central banks as a result of the freezing of Russian central bank assets. That's what triggered a large purchase of 1,000+ tons a year from that community in the gold market, and that can trigger a rally. So central banks, the problem they have is the dollar is getting too strong, right? So when you have to defend the value of your currency, you don't really have that much cash available to go out and buy gold. And that's why gold prices have kind of slowed down. To your question, is geopolitical risk still a reason to buy gold? The answer is yes. We saw it yesterday again. And we could see it farther out. I mean, remember, for the first time ever, we were saying rates in Europe trading, or bonds in Europe trading above swaps, right? So the market's clearly anxious when it comes to the rates market, what's going on in France. We are anxious about Russia, Ukraine, where we've seen an escalation of tensions. But of course, central banks don't have the liquidity right now, don't have the position to keep accumulating gold in large scale. So that's going to slow down the rally. So we think probably the next few months, gold slows down, but we still believe $3,000 an ounce will be reached at some point end of next year.
Dollar down, gold up. That's it, right? If we see the dollar going down, you buy gold, because then therefore the central banks have more liquidity to buy it.
Yeah, and I think we need to see that uber strength of the U.S. economy kind of easing off a bit, right? I mean, that's been the trigger for the pullback in gold, just the U.S. getting too strong, and like I said, I mean, central banks may not having the balance sheet to keep purchasing gold at the same scale they have for the last year. So, but to your point, yeah, if gold, if the dollar finally starts to weaken a bit, if that super strong rates market that you have in the U.S., where you know the terminal rates now 4% for the U.S. next year. In Europe, we're looking at rates way lower than that. Maybe like, you know, we could see rates going down 2% or sub 2% throughout the course of next year, right? So it's that dynamic going on.